Most people are familiar with moving money out of an employer plan like a 401k and rolling the money over to an IRA. But what about a reverse rollover or moving the money from an IRA over to an employer plan? Well, that's what we're going to talk about in the next couple of minutes. We'll cover what exactly it means and when it might make the most sense, and then a couple of things to be aware of if you're considering doing this. So what is a reverse rollover? Again, it's just moving that money from an individual account that you control over into a workplace account. And there are a couple of reasons to do that we'll get into. The term reverse rollover has been picking up steam. I'm not sure why. In the financial world, we always need to have these cool sounding names, and I guess that way we get to sound more important and smart when we talk about them. But it's really just moving that money the opposite direction that people typically move it. So a lot of times when somebody leaves a job and they've been saving money in their 401k, 403b, etc., they will eventually usually move that money to an IRA. That's not always the right choice. You want to do some careful analysis to make sure that it makes sense. Look at the fees, look at the investment options, look at a number of different things. Got a video that discusses that, and you can check that out as well. But typically that's what happens. So the reverse rollover is really just moving that money from the individual account into an employer plan. So when might it make the most sense to do a reverse rollover? I don't see a lot of clients doing this, but from time to time it makes sense, and it's at least worth knowing about that. So one of the reasons might be is if you want to delay your RMDs while you're working. So the IRS doesn't let you keep money in tax protected accounts indefinitely. They say eventually you have to start taking these required minimum distributions or RMDs, and that's especially true with those pre-tax retirement accounts. But if you are still working for your employer that offers the 401k that you roll the money into, then you may be able to postpone your RMDs, at least until you stop working. There are a couple of rules to be aware of, so check with your CPA. For instance, if you are a company owner, you might not be able to postpone those RMDs, but most employees could possibly move that money out of their IRAs and into the 401k and not have to take the RMDs. That typically is something that only matters if you're 72 or older these days, so it doesn't apply to everybody. For those who are younger, you could consider using the so-called rule of 55. Really what this means is that when you leave employment from an employer that has a 401k, you can potentially take distributions out of that 401k after age 55, assuming you left the job after age 55, without an early distribution penalty. So that can be helpful if you're in that window between age 55 and 59 and a half. So 59 and a half is important because once you reach that age, you could take those distributions out of your IRA without the early withdrawal penalty. But having the money in a 401k or maybe moving your money into your current job's 401k right before you stop working after age 55 could potentially allow you to access those funds sooner. There are obviously pros and cons of doing that and drawing on those funds sooner and taking the distributions straight from the 401k instead of from an IRA, but it is something that might be worth considering if you are retiring in that window and you want to access the funds that are currently in your IRA. Another biggie for people is if they want to do those backdoor Roth IRA contributions. So the IRS limits your ability to contribute to a Roth IRA. So that could be based on your income. And if you earn above a certain amount, you're not allowed to make Roth IRA contributions. What you can still do, though, is make a contribution, assuming you have the earned income, to a traditional IRA. It's a non-deductible IRA contribution in many cases. So it can be helpful to shortly after convert that non-deductible contribution, convert that to a Roth IRA, and there's typically no tax consequences or very minor tax consequences if you do that. However, there is a wrinkle in that backdoor IRA strategy. So what can happen is if you have pre-tax IRA balances out there, let's say you have a big chunk of pre-tax money from your previous job or a couple of jobs ago, it's in an IRA, and the IRS looks at all of your IRA accounts under what's called the pro rata rule. So those other IRA balances are going to interfere with your ability to make those backdoor Roth contributions with little or no tax consequences. You're probably going to end up paying more than you expected if you get caught by the pro rata rule. Well, this reverse rollover strategy is a way to, I guess, get around that. So what you do is you take the money out of your pre-tax IRAs, you put it into your employer's plan, like your 401k, and when they're in that plan under the current rules, they don't count towards that pro rata rule. So essentially, you can take your pre-tax IRA balances and turn them into zero by moving all that money into your workplace plan. So that's a way to potentially make those backdoor Roth contributions without getting hung up with the pro rata rule. Next, you might have some really good investment options in your workplace plan. So it could make sense to say, I've got this IRA that's nothing special, but I really like what's going on in the workplace plan. So you could potentially move the money out of the IRA to the workplace plan to take advantage of those investment options. One in particular that commonly comes up is a stable value fund. So that's going to be similar to a money market or a savings account. It's not FDIC insured typically. It's generally going to be offered by an insurance company that's somehow associated with your 401k. But those can be nice options because they're pretty low risk. They're very low risk. They don't fluctuate with the markets, but they tend to pay more than the typical money market fund pays. So you're generally going to get extra interest earnings at very low risk, but you generally can't find those kinds of things out in the IRA world. They're often only available in those employer plans. So that could be another reason to think about moving money from the IRA over to the employer plan. What about loans? Sometimes people want to borrow against their 401k balance, for example. And if you move money into the 401k, it might give you a bigger balance to borrow from. This is something you certainly want to check with your employer, with your plan administrator, and just verify if that's the case, because it might not be. But this is a way to potentially increase the amount you can borrow from your 401k. There are naturally pros and cons of borrowing from a 401k. One of them in particular, one of the drawbacks in particular, is that you need to repay that loan. And if you leave that job, then it can get a little more complicated if you have an outstanding loan balance. It could potentially even be counted as a distribution and possibly cause income tax problems, additional tax penalties. So be very careful if you're thinking about that, but it might be one way to boost what you can borrow from your workplace plan. There's also the question of creditor protection, and this is something that you really want to speak with an attorney about and get very good details on. So in many states, you have quite good creditor protection in an IRA and in a 401k. But in some cases, your protection might be better in a workplace plan like your 401k. It might be, it might not. Again, you want to talk with an attorney. So if you have those concerns, it could make sense to take the funds out of an IRA, move them to a 401k, and maybe rest a little bit easier. By the way, I'm Justin Pritchard, and I help people plan for retirement and invest for the future. And in the description below, you're going to find some nice resources, some articles that cover this, as well as some broader and general retirement planning type resources. So please check those out. I think you'll find that really helpful. And this is also a good time for a friendly reminder that this is just a short video. It doesn't give you all of the information you need to make these important decisions. So please contact a professional, an attorney, a CPA, financial planner before you make any big decisions. Hit pause and read that if you need more time. So a couple things to be aware of if you decide to go this route. Number one is you want to think about how easy it might be to get the money back out of the workplace retirement plan. This might not be a big issue for you, but it is something to at least think about. So when you take money out of an IRA, it's generally very easy. You might have your bank account linked, and you can just go online and zap that money over to your bank account. However, with a 401k, it might be a little more convoluted, and generally your employer needs to authorize those types of distributions. So maybe if you stop working, that one's pretty easy. They have maybe signed off on something that says you left the organization and you can take a distribution whenever you want. but sometimes these things take time, and that's especially true with very small and disorganized type employers. So keep that in mind if you're going to put your life savings into a workplace plan like that. There's also the question of how exactly you do this. How do you get the money from the IRA into the plan? And I'd say just contact both of the vendors. So contact the 401k provider, 403b provider, whatever it is, and say, hey, I've got an IRA, I'd like to move it over, and they can tell you what you need to do. But you'll also need to talk with your current IRA custodian, because it's not as easy as just moving from one IRA to another IRA. That's generally very easy paperwork. Instead, what you're doing is basically moving from an IRA to a 401k. So the process, the logistics are more cumbersome. It's, not necessarily painful, but it might be different from what you're used to. You're going to need a letter of acceptance probably. So find out what exactly their requirements are, and then you can start the process. And one of those reasons to contact your employer first is to find out if you even can roll money in. So does the plan accept it? And in many cases, yes, they do. The 401k vendors are more than happy to gather assets and increase the amount of money in the plan. So that's okay, but just double check that before you spend too much time on this. Along similar lines, you do lose some control when you move money into a workplace retirement plan. So you don't necessarily get to pick all of the investments. If you have an excellent plan with good, high quality, low cost investments, then that's great. You might be more than happy to move your assets into that account. But you don't necessarily control which vendors your employer uses. So if the employer decides to change things, whether that's moving the whole plan somewhere else or they're going to switch some of the investments in the lineup or on the menu, that's not something that you generally have any control over. So you're sort of subject to just hoping that your employer does a good job and is paying attention to the plan. And then there are the plan fees that you, again, don't really control. So you want to make sure that you have a reasonably priced plan and that you continue to monitor the pricing on that. Just look at those annual fee disclosures or contact the vendors and ask them to tell you what exactly it costs and make sure that that's all accurate. And if it's reasonably priced, then that's great. Keep in mind that all of this is for your pre-tax retirement account balances only under current law, and at least according to my understanding. So it might not matter to you. You might not have much desire to move a Roth IRA into your Roth 401k, but you generally can't do that. So, triple check whatever you're thinking of doing with your plan administrator and just say, hey, can I do this? And then if you're wondering about your annual limits, this generally doesn't have any impact on that. So if you empty out your IRA by moving it over to your 401k, you're not all of a sudden going to be able to contribute again if you already used up your annual IRA contribution limit. You've already met that, so you can't do anything there. Likewise, when you do that rollover, assuming it happens properly as a rollover or a direct transfer between investment firms, that's also not going to affect your limit on your workplace plan. So it won't count against you. You should still be able to contribute to that plan, up to the annual maximum limits that apply to you. So I hope you found that helpful. If you did, please leave a quick thumbs up. Thank you and take care.